I've been trying to gauge all day, talking to senior bankers at different firms all day, the response to the Fed's emergency actions last night, and the answers are not good. The best thing I heard was it will work, it will take time. But I asked somebody else, they said, is anything better today in terms of being narrower in spread? And the answer was no. Let me tell you some of the issues about the markets remaining on edge. Point number one I've heard out there, some U.S. funding markets still not functioning smoothly. That led the Fed to do an unscheduled $500 billion overnight repo, a second one during the day. There wasn't much take up on that, which may be good news compared to the morning where they took down 129 billion. The afternoon they took down only 19. Huge submissions for these Fed Treasury purchases. As we described all day, the Fed is in the market during the day in a series of purchases of $40 billion of Treasuries and mortgage-backed securities. But the market continues to call for the Fed to do more. We're hearing repeated calls for the Fed to get involved in the commercial paper market and other directed lending that needs to be done, perhaps to certain industries. One of the things that we can tell you guys is the outlook for the U.S. economy now has changed dramatically. We did a Fed survey over the weekend. Now there is a 67% probability of a recession in the next 12 months, and that is up from a 41% already elevated in January. That is the highest probability we've had in the 10 years we've been asking this question. Now I want to walk you through the outlook for the 40 respondents for growth by quarter. And what you see is a modest first quarter, not really a big hit in the first quarter, but now look at the second quarter where you have a big negative there of minus 1.8% on an annualized basis, going flat in the third quarter, and then finally you get a rebound in the fourth quarter. This is upon available information. And now I hate to provide even more news, but the forecasters at the UCLA Anderson forecasting shop there, they just put out a release saying the U.S. may already be in recession right now, according to their gauge of the economic data. Kelly?
Steve, I have one follow-up question for you. So the Fed today said it was going to do about $500 billion of repo, that kind of emergency liquidity or funding. Then came the news that they accepted just $19 billion worth of bids. So they offered $500 billion and only $19 billion of it was taken up. I mean, what does that tell us?
Well, let me go back because, that was the second offering. So they actually offered $1 trillion in repo today, as you know.
Wow.
And in the morning, they took up 129. So I wouldn't get hung up on the 500 billion number. 500 billion is a Fed proxy for infinity offering.
Okay.
We will offer you as much as you need. That's the way to think about 500 billion. They don't mean 500. They don't know if 500 is needed. 500 is their gauge of the most ever that the market could need, so that there's as much ample supply for the repo market as may be needed. So the 19 is a good sign. It is not a good sign the Fed felt a need to come in with a second repo action or auction today. But it may be a good sign that in the afternoon they only took down 19 billion. We're going to have to watch these markets. You're going to have to be on the phone talking to people who are saying, look, some of these markets are broken. And in the way to think about what the Fed did last night, Kelly, is really focused on getting these markets to work, because at the end of the day, nothing really matters if the U.S. dollar funding markets aren't working.